Hi, Isabella. I'm not sure if you were on before when my audio or all of my stuff wasn't working. How are you? I just unmuted you.
Oh, can you hear me?
Yeah, I can hear you.
Oh,
Is it clear on my end?
yeah.
Oh, thank goodness. Okay. I had to restart my computer. It kept crashing on me. The Zoom was crashing. So,
Dang. Yeah, that's what was happening to my class yesterday in English. It was really
ugh.
weird.
I think for me it was because I hadn't done the updates on my computer, and
Mm,
now I finally did it, and
it just
it's
needs to
fine.
happen.
Yeah, I think it just like slows it down. Hi, Servat. How are you? But I told everybody to come back at 10:30 because I wasn't sure how long the updates were going to take. So if you guys have any questions on
Oh, okay.
homework or anything, let me know.
Yeah, I did. I
Was
was
it?
doing the what's it called? The pre-assignment I was due yesterday,
Yeah.
and toward the end I had some questions, but I'll just email you to schedule a conference, a
Okay.
physical conference call.
Perfect.
Yeah,
That
it's
sounds
okay.
good.
Uh-huh.
Is it on?
Hey, Josh.
Hey, is this how this works?
Yeah,
Okay.
I think it's better. I'll put it back on the share screen so you guys can see it.
All right.
I just restarted, so I think that helped a lot.
Yeah, I can hear you clear from here.
Awesome. That's good to know.
Except there's just not many people out here yet.
I know. I'm hoping that it's not because of that. Worst case, so we'll just like shut down the video portion for everybody except for me if we have to. But as long as it's coming clear on my side, then you guys are good, right?
Yeah.
Yeah.
Okay. You know, like Ferris Bueller, I totally felt like that teacher for a second.
Mhm.
But even more awkward because you can't see anything.
Yeah, this is pretty weird.
Yeah, technology is good and then it's not. Like you feel like you're back in like 2001 or something. like the, I think we were past dial up at that point, but still,
Yeah.
it was not the best connection, even wired. I'll wait a few minutes. You guys can see the screen though, right?
Yeah.
Okay.
Yeah, I
So
can see it from here.
perfect. You can start writing that stuff out if you want to.
Sure.
Whew, good thing the restart worked.
I know, and I'm surprised it was pretty quick too.
Yeah, because usually those update ones, I'm like, oh geez, it could take like 20 minutes.
Yeah.
Those updates are the worst. I always put them off. That's my problem.
Oh no, me too. I have one from like December.
Well, and then I read somewhere like, oh, if this is happening to you, it's probably because you didn't update. And I was like, okay, fine.
Yeah,
Now I
that's
need to update.
usually always the problem.
I wish they would tell you how long the update would take, because then I would do it, you know, more
Yeah,
likely.
yeah. Some of the updates take hours.
Exactly. I do not have that kind of time around, like lying around. And then on my phone, when I do an update, I'm always afraid it's going to clear out my pictures or something.
Oh yeah, yeah, yeah. You should get them backed up.
Yeah, I have it backed up, but sometimes I'm always paranoid because when my daughter was like a few days old, my phone crashed and I lost like days of pictures.
Oh, you lost all those pictures?
I lost a whole bunch of pictures. I was really sad about it because they change a lot when they're really little.
Yeah, yeah, fast too.
Yeah, and I was like, "Oh my gosh, what, do I have them?" And then my husband had a few, so I was like, "Okay."
Yeah, yeah. I was just gonna say.
I became like that
Family
obsessive
members too.
mom that takes like crazy pictures.
Oh.
Let's see. Trying to make it as comfortable as possible. I'm finally thinking I need to get like one of those tables or something. Are most of your teachers?
Oh,
Oh, which picture did you see?
yeah, that's so cute.
You guys missed it, or like 10 minutes before I got on, our neighbor who has like my daughter's best friend is her daughter walked by, and my daughter
Oh,
had a massive tantrum afterwards, like because she's not, it's hard for them to process what's going on this age. It's so, oh my gosh, it was rough.
I can already imagine.
Like this cannot happen next to like during the class. This is not going to happen.
Yeah, yeah. Oh,
But it got better.
how old is she?
She's 3.5.
Oh, wow.
Yeah.
Oh, is she a little chatterbox?
Oh my goodness, yes. She like on the scale of like introvert to like extrovert, she's like the farthest over on the extrovert side that you can get. I She's like nonstop talk all day long. Okay, I'm just gonna check. So we've got almost everybody's back. Do you guys want me to start?
Yeah, that's fine.
Okay. So what I was saying is that I was expecting you to have or just to be slightly confused with the revenue recognition stuff. The wording of how they even came up with the new principle is confusing in and of itself. I mean, even us accountants who have been in it for years had to really kind of like think about and analyze it because it's highly subjective, and how they worded it is really subjective. We used to have revenue principles and guidelines for different industries, and so different industries would recognize revenue differently. And what the IFRS and then the US GAAP FASB was trying to do was basically come up with principles that could be used across industries. So they came up with this very kind of convoluted 5-step process of recognizing revenue, which is what you're going to see over here. But in general, revenue is recognized when it's earned, right? We have to do something in order to earn our revenue. In this class, it's pretty basic, right? How do I earn revenue? If I'm selling something, what do I need to do?
Well, you need to sell it.
Yes, sell the goods.
Perform the service.
Yep, or perform the service. So we're not going to recognize revenue before that, before we sell the goods, or transfer title of those goods, so transferring ownership of those goods, and we're not going to recognize before we perform the service. How much revenue we're recognizing is typically going to be the amount of cash that we receive, right? Or the fair market value of those assets that we are exchanging for. So the equivalent in accounts receivable. So if I sell something to a customer on account, I'm expecting them to pay me back the value, right? The new revenue recognition principles are basically saying that revenue is recognized based on a contract. So it's either a written contract or an oral contract. So an informal agreement is that oral contract. And contract is an agreement between two parties, right? So the buyer and the seller, that creates enforceable rights or performance obligations. So even in that kind of definition of contract, they even start using these weird terms: enforceable rights, performance obligations, right? Who are the two parties to an agreement, to this agreement that we're talking about for revenue recognition?
Well, the two people that are involved in the contract, right? The ones that want to make a business or something.
Yes.
The seller and the buyer.
Yeah, the buyer and the seller. I like to break it down into the easiest terms. So the buyer and the seller. One person's buying it, another person's selling it. When we're talking about enforceable rights or performance obligations, it's just what needs to happen. What does the seller need to do and what does the buyer need to do? So if I'm talking about me as the customer and Target is the seller, right? In order for Target to recognize revenue from whatever I purchase, what needs to happen? They need to give me the goods and I need to give them some sort of currency, some currency in exchange, right? For recognizing revenue, we go through this 5-step process and we're analyzing the contract. So in industries like technology and even maybe financial services, any companies that have warranties or additional kind of stipulations or contracts that could change the terms, this gets very complicated. So the first step is that we identify the contract. So who are the two parties in the contract? What is the contract? So what is being exchanged? How much is the contract for, etc. Within that contract, the second step is that we're going to identify the performance obligations. So what does the buyer need to do and what does the seller need to do and when do they need to do it? If I'm talking about construction, you could have multiple performance obligations. Finishing a garage could be a performance obligation. Finishing the house construction could be a performance obligation. So you could have different performance obligations within one contract. After you identify those performance obligations, we're going to determine the transaction price. So that's how much we're going to recognize. So how much revenue to recognize? And we already got the definition of that performance obligation over there. Fourth step is allocate the transaction price to the performance obligations. So in this class, it's whenever goods transfer to the customer. So when does title, when does ownership of that inventory move from Target to me? And it depends on shipping terms. It could depend on timing of certain transactions. So if there's any delay in receiving the goods, it could put off when we're recognizing revenue. In this class, it's fairly easy to figure out the allocation of the transaction price to the performance obligations. If I'm talking about an intermediate accounting class, it gets much more complicated. And if you want to see that how complicated it is, look at Intuit's financial statements for 2019. I think it was September 30th, 2019 was their year end last year. And their audit opinion from their auditors actually stipulated how they got comfortable, but not comfortable enough with how much revenue was recognized and when the revenue was recognized, which kind of puts into question all of the revenue they recognized last year. That's something that most auditors don't do. We don't usually put that in there because we're usually pretty comfortable with how much and when revenue is recognized. But under these principles, it's kind of a little bit too gray for us at times. For the last step, recognize revenue when the entity satisfies the obligations. As soon as title transfers, or as soon as we perform those services, we recognize revenue. Does that make sense? So we're going to go back to this. We'll have this 5-step process still there, but I'm going to move on down to an example for us. This chapter, you're going to have a lot of journal entries. So first question. So assume Turkey Inc. delivers a truckload of earrings to a Nordstrom store in San Diego. First things first. Who's the buyer?
Nordstrom.
Yep. Buyer. Who is the seller?
Assume turkey.
Yeah. Turkey Inc. And what is the contract? What's Nordstrom buying?
20,000
Buying
earrings.
20,000 earrings.
Yep. 20,000 pairs of earrings, right? On the truck are 20,000 earrings each, and I mean pairs, by the way, each of which Turkey Inc. sells to Nordstrom for $150 on account. Okay, so that 20,000 pairs, somebody's here at airport. The 20,000 pairs are the units, right? Units being sold. The $150 is what?
It's like X amount per unit.
The selling price per unit. Oops, sorry. Keep moving it on accident. Okay. Each pair of earrings costs Turkey $70 to produce. So we have two different values. Do you see that?
Yes.
Why do we have two different values?
Because we also have to like take account how much Turkey Inc. is profiting per pair of earring.
Correct. So we also have to take into account the cost basis, and netting out is the profit. So, but we're going to take into account the cost basis. Oopsie. So the inventory cost, if you will. In the last 4 chapters, we've always been dealing with we've always been dealing with services, right? In this chapter, this is the first chapter that we're going to introduce sales that are of goods. It's not going to be a service provider, it's a retailer or a wholesaler selling to a retailer. So when we are selling goods, we have 2 pieces of information. We have the selling price, which is how much the seller is selling these goods to the buyer for. And then we have the cost basis of those goods, which is how much this seller purchased those goods for, or what their manufacturing cost was. I wrote in here that they received the goods on December 20th. So Nordstrom received the goods on December 20th and cash was paid on 12/31. So what date can this company recognize revenue? What date can we record the sale for Turkey?
On the 31st.
Nope. Thank you, though.
Is it the 20th one?
It's the 20th. So if I was a cash basis, if I was using a cash basis, then you would be correct. The 31st would be when I would be recognizing revenue, but we're accrual basis. So
Oh, because they go on account, right? Okay.
yeah, because title transferred when it was delivered in this case. So we delivered those goods on December 20th. So that's when we're recognizing revenue. So on December 20th, that's when we delivered the goods. We're going to need to do a calculation, obviously, but we're going to have one debit and one credit. Let's figure out how much revenue we're going to recognize. So how do I figure out how to calculate this?
So it's $3 million.
No, I don't care about the total yet. Don't give me the total. I don't want the total. How do I figure out that total?
You multiply 20,000 times the unit cost.
So 20,000 units sold. And I want you to get in the process of writing it out with words, because in later chapters, it'll come in handy. And in the next accounting class, it will definitely come in handy. 20,000 units sold at a selling price of $150 per unit. So the amount of revenue that we recognized is based on the selling price. So the total is the 3 million. That is correct. What am I going to debit?
1.4 that they paid for it.
Oh, no, not yet. What am I going to debit? What's the account? How do I record the sale?
Receivable?
Accounts receivable.
There we go. Debit accounts receivable. See, that's not, this is nothing new. So debit accounts receivable. Sorry, guys. Increasing accounts receivable, right, for 3 million. And we're going to credit
Sales revenue?
sales revenue. Yep. Because we sold goods, so it's sales revenue. Increasing sales revenue for 3 million. Bless you.
That's
Thank you. And really quick, you got the 3 million from multiplying 20,000 by 150. right?
Correct. Yeah. So I'm just writing revenue recognized from this sale. So is this journal entry basically the same one that you've been doing for a while?
Yeah, just recording like what's going on.
Yeah, it's just recording accounts receivable. We're increasing accounts receivable for 3 million because we now have this amount owed to us. And the only difference is now instead of crediting service revenue, we're crediting sales revenue because it's selling of goods. The second entry. So when we sell goods, we also need to account for the cost basis of those goods at the same time. So remember the matching principle from chapter 3? We're matching the cost of those goods that we sold against the sales in the same period. So if we didn't have this inventory to sell to Nordstrom, if we didn't have these earrings to sell to Nordstrom, we would not have the sale, right? We wouldn't have revenue to recognize. So on December 20th, we're going to have a separate entry to record. And this is because title transferred to Nordstrom on this date. So title meaning ownership of the goods. We're recording the cost of the sale at our cost basis. So this is also Turkey Inc. on the Turkey Inc. side. Because we're only looking at it from the seller's perspective in this chapter, not the buyer. For the cost of the sale, how many units did we sell?
20,000.
20,000 units sold. Okay. And I'm going to highlight it so it's very obvious to you. Same 20,000, right? So we're recognizing revenue on those units sold, and the same units sold is what we're expensing. But we're not expensing them at our selling price. We're expensing them at our cost basis. How much it cost us to purchase these. $70. So essentially, I had these earrings that I paid $70 for. I marked it up by $80, right? And I sold it for $150 per unit. Does that make sense?
Yes.
So my profit on this is $80 per unit.
So then do we just subtract the 1,400,000 by? Nope.
No. So we don't ever do the subtraction. We keep it separate. It goes into separate accounts. In the income statement is where you see it. You'll see sales revenue less cost of goods sold, and then you're going to see gross profit in the income statement. So we don't net it in the transaction level. We don't net it in the accounts. It gets netted in the income statement. We'll talk more about gross profit in the next chapter. That's why I'm not going to go into it here. That's
You
okay.
said only in the income statement?
What was that?
You said only in the income statement?
Yeah, in the income statement is where you're going to see the netting effect.
Okay.
Was there another question? Okay. So what am I going to debit? What's the account that we use to record that cost basis?
Account receivable.
No. Cost, it's from chapter 2. We did have the account. So it's cost of goods sold.
Oh, cost expense.
Yeah. Cost of goods sold is the account that we usually use. Some companies call it cost of sale, but most companies do call it cost of goods sold. So COGS.
Can we write it like that, or would you rather us write out the whole phrase?
You can totally write it out COGS if you want to. Cost of goods sold. I'll get lazy in later
increases,
chapters. What was that?
It increases?
Yeah. So this is an expense account. It's going to increase by the 1.4 million. I'm just going to write this off to the side. It's an expense account that you do pay attention to. That's why a lot of companies do show it separately from their other operating expenses in their income statement. Your favorite company, Apple, does not show cost of goods sold. Something to think about.
Is it because they're doing like child labor and stuff and all that? You know, good
I'm
stuff?
not getting it. I did not say that. I don't know. But I'm just saying that it's probably because their cost of goods sold is not very high.
We're
Compared to the
overpaying,
revenue.
basically. Overpaying for all this.
Correct. Didn't say that, but it's implied. So we're going to debit cost of goods sold. It's coming out of inventory. Okay. So when we sell goods, it's no longer inventory. It's no longer goods available for sale, right? Inventory are goods available for sale. Now it's been sold, so it's expensed as cost of goods sold. So inventory, the asset account reduces by 1.4 million. I'm going to highlight the date too. so that you see it happens in the same period, same date when we're recognizing revenue. So I'm just going to put the T account for accounts receivable down here. I don't know what the beginning balance is. I'm just going to make it up as 0. On 12/20, right? $3 million was debited to accounts receivable. When does Turkey Inc. collect from Nordstrom? I put it back up here.
Yeah.
31st, right?
31st, yeah. So cash paid on 12/31. So it doesn't say if it was a certain amount. We're just going to assume the entire amount was paid. So on December 31st, what's the entry? We're going to debit.
Cash?
Yep, cash. Increasing cash for how much? How much does Nordstrom pay Turkey?
3 million.
3 million.
3 million.
Yep. And then we're going to credit which account?
Sales revenue.
Nope. So if we,
Accounts receivable.
and
Oh, yeah.
I'll say why it's not sales revenue, and thank you for using that one. If I was to credit sales revenue here, how much in total revenue would I recognize for that December?
6
Six.
million.
Yeah.
6 million.
6 million, right? I would have been double recognizing revenue, double counting that 3 million. So we're not going to recognize it again. It's already been recognized when it was earned, when we delivered it to Nordstrom. Now we're just collecting cash from customers. So we're going to do what to the account?
Accounts payable. Or
Nope.
Account
Account receivable. Yeah. So we're going to reduce accounts receivable with that credit. It's no longer owed to us from Nordstrom because they paid it off. So now what Nordstrom owes at 12/31 is 0. So balance owed from Nordstrom, 0. Does that make sense? The first journal entry and the third journal entry, those are nothing new, right? They're from chapter 2. You've been doing them for a while. I know it's been a while since you've recorded them, but the only new entry really that we're adding on here is journal entry 2. Questions? Do you need a break? Are you good? Stand up, do some jumping jacks. Are you smiling? Hi.
no, I'm definitely not.
You're not smiling?
No.
Oh, bummer. Nate's smiling. I see Nate smiling. I'm scrolling through my pictures. Okay.
Hmm?
What? Okay. We're gonna move on. Good? I drew for you. This is my favorite one. Get a little drawing.
Wow.
Okay. So that last one was kind of basic, and I wanted it to be basic on purpose. So we're going to add on to our initial concepts of revenue recognition with shipping terms. So the timing of when revenue is recognized is impacted by shipping terms. In real life, we use the terms free on board, FOB. I don't know why they call it free on board, but we call it free on board. And we have two normal shipping terms that are available. FOB shipping point and FOB destination. The seller is the individual or the party that's making the decision whether the shipping terms are FOB shipping point or FOB destination. The buyer doesn't usually have much choice in the matter in general. So the timing of when they recognize revenue under these two methods is different. It could be months in between, especially if we're selling from.
Are you talking about the time the seller recognizes it or the buyer?
Correct, both. Well, it's the seller, it's when the seller recognizes revenue and when the buyer actually has ownership of the goods. So it does impact both sides. But it's the seller when the seller is recognizing revenue. So if we're selling and we're just giving goods when a customer comes in the store, this isn't really affecting them, right? This is affecting customers or parties that are selling goods across the world. And if I am sending something by a plane, it's a lot faster to get to my customer than it is if I'm sending it by boat or train or car. So all of these things are going to impact the seller and when they're recognizing revenue. FOB shipping. So we're going to look at an example with Craft Beer Company. They're the seller. And Mona Lisa Deli. Anybody know where that is?
I've actually heard of that before.
It's in San Diego. They have one location in Little Italy. It's amazing. If you haven't been there, go sometime soon-ish, whenever you can. But anyways, so Craft Beer Company is the seller. Mona Lisa Deli is going to be our buyer. So Craft Beer is going to ship goods using UPS. Shipping company, right? Transport company. To Mona Lisa. If I am using the terms FOB shipping point, as soon as Craft Beer Company, the seller, releases the goods to UPS, as soon as they hand off those packages to UPS, they get to recognize revenue.
So then if something happens, that's when UPS becomes liable?
No, technically they're not. So when is revenue recognized for FOB shipping point? As soon as it's shipped. So upon shipment. If that, not bus, but if that truck catches on fire, gets in a car accident, if any of those goods are damaged in transit, it's the buyer's responsibility to have insurance on those goods in transit. It's the buyer's responsibility to pay for shipping in transit. And it's the buyer who is risking loss. The buyer is paying for the shipping, the buyer is paying for insurance, and the buyer is responsible if there's any damages that happen in transit. So who pays the shipping and insurance in transit for FOB shipping point? The buyer. So if I am making a purchase and the terms are FOB shipping point, the buyer is going to include those costs in their inventory cost. It's part of the cost of getting those goods to the buyer's warehouse or the buyer's storefront. Who owns the goods in transit for FOB shipping point?
Well, wouldn't the buyer own it if he's owning all the
Yep.
liability?
Correct. So the buyer owns the goods in transit. So what does that mean for the buyer in their inventory count? They're not going to count those goods, but they actually have to add those to their count of inventory because it's technically their inventory in transit, even though it hasn't, they haven't received it yet. Because title transferred upon shipment. When does the seller recognize the cost of goods sold? Under FOB shipping point.
On
When
ship-
UPS picks it up.
Upon shipment, as soon as UPS picks it up, correct?
Is there
So
like certain companies that use like FOB shipping point as opposed to FOB destination? Like, is there certain industries that only use certain, you know, these two different types?
I would say, well, 100% the most common terms are FOB shipping point.
Okay, so there's
Yeah. Most companies are going to use that because shipping costs are expensive, right? They don't want to
Yeah.
pay for it. They want the buyer to bear that. And they also don't want to be responsible for the goods. Before the new revenue recognition principles came out, we, as accounting professionals, kind of ignored the fact that a lot of companies, even though they're using FOB shipping point terms, if something happened in transit, just to keep the relationship good between the buyer and the seller would typically replace those goods. Now, the Rev Rec rules, they actually have stipulated that if they are treating it like that, if they are going to replace goods that are in transit, then they actually don't get to recognize revenue upon shipment. So they've actually taken account for that because FOB shipping point is ideal for sellers because they get to recognize things as soon as it leaves their facility, right? As soon as they give it to UPS, FedEx, they get to recognize revenue. So it's the earliest point in time they get to recognize revenue. So if you think about companies where they have a lot of shipments at the end of the year, or if they have a lot of purchases at the end of the year, they're going to work to fulfill those orders and get them out the door as soon as possible. Because that's when they get to recognize revenue, as soon as it's shipped. If those goods are not shipped as of year end, they don't get to recognize revenue on those orders that came in at the end of the year. For the other end of it, so FOB destination, the seller is still responsible for those goods in transit all the way to Mona Lisa's deli. As soon as it's delivered, that's when they get to recognize revenue under FOB destination. So when is revenue recognized? Upon delivery. Customer. Who pays for the shipping? Who pays for the insurance in transit? Who's bearing the risk of loss of those goods if anything happens to that UPS truck in transit?
The buyer.
Nope. Not under FOB destination.
seller.
The seller. Because the seller is still responsible for those goods. Those goods are still technically theirs, even though they left their facility under FOB destination. Under FOB destination, title doesn't transfer to the buyer until delivery. So who owns the goods in transit? The seller. So the seller is responsible for shipping costs. The seller is responsible for insurance costs in transit. And shipping costs and insurance costs from the seller's perspective are operating expenses. It's not part of cost of goods sold.
So I have a question.
Yes.
For FOB shipping point,
Uh-huh.
they recognize their revenue once it ships out, right?
Correct.
Okay.
So FOB shipping point, as soon as it ships, they're recognizing revenue. FOB destination has to be delivered. So if I'm talking about a company in the US that's shipping something to Australia, right? If I'm using FOB shipping point, I'm recognizing it as soon as I ship it off. If I'm using FOB destination and I'm using a boat to get to Australia, and a boat that could be stopping at many different ports, it could be months before I can actually recognize revenue under FOB destination. Because I have to have it delivered to my customer in order to recognize it. So the timing is very different under the two terms in those two scenarios. Does that make sense?
Yeah.
And do
That's
you
crazy.
see why? And do you see why most companies would choose to have FOB shipping point as their terms?
Yeah, they'd like rather get rid of it.
Exactly. Recognize revenue as fast as possible. Get rid of that cost, in transit cost too. So when does the seller recognize cost of goods sold under FOB destination?
Wouldn't it also be upon delivery to the customer?
Correct. Yep, upon delivery. So if this transaction is happening at year end and I'm using FOB destination, I want to get those goods delivered to my customer as fast as I can. I'm going to do anything to get those goods delivered to my customer by year end. So I can recognize revenue in the period that I'm giving or have that order, right? Have that sale. I love Amazon because it's a great example and you have both options. You have both FOB shipping point and you have FOB destination in just one company. So Amazon Prime, right? Who's paying for shipping costs under Amazon Prime?
Amazon would be, right?
Amazon's paying for it, right? So under Amazon Prime, what is it? FOB destination or FOB shipping point?
Shipping point.
Yep. No, opposite.
No?
It's FOB destination
Dang.
because Amazon is the seller, right?
Amazon seller, yeah.
So they're paying for the shipping costs. Think about it. Think about Amazon Prime. Amazon Prime and even Prime Now, well, not right now, but usually, how quickly are they getting goods to customers if I'm using Amazon Prime Now?
It's almost
Super
like
fast.
same day or next day delivery.
1 hour or 2 hours.
Oh, shit.
They have 1 hour and 2 hour options in San Diego, not around the world yet. But
would that be shipping point for them?
no, it's FOB destination because
But
they
I'm
need to
paying
deliver
for
it. They need to deliver it. So in order to recognize revenue as soon as possible, they're going to deliver it within an hour of the order, right? That's a really quick turnover for a company that's shipping goods.
Oh, okay.
So Amazon Prime, Amazon's bearing the risk of insurance and costs of shipping. Amazon owns the goods in transit, so they want to get it delivered as soon as possible to their customers to recognize revenue. Because they have to wait until it's delivered. For the normal Amazon, the non-Prime transactions, I'll say Amazon regular, The buyer typically pays for insurance. The buyer typically, or has the option to pay for insurance in transit. The buyer typically pays for shipping costs, right? It's usually from the third party sellers. And the seller gets to recognize revenue, and it's going to reduce the inventory costs upon shipment. So they don't really care how long it takes. Think about it. Think about the Amazon purchases that you make that you have to pay for shipping. It usually takes longer for those goods to be delivered to you. And it's not necessarily because of where they're coming from. It's because of the fact that they don't really care when it gets delivered to you necessarily, because they're recognizing revenue upon shipment. Does that make sense?
Bastards. Yeah.
So with this particular chapter and in future chapters, you're going to want to pay attention to the dates, because the dates are going to matter. And you're also going to want to keep track of the terms. Is it FOB shipping point or is it FOB destination? And pay attention to the delivery date if it's FOB destination, and pay attention to the shipping date if it's FOB shipping, because those are when you're going to recognize revenue. Good?
Boom. Good.
Thanks, Alex. Okay. We're moving on. So we talked a lot about speeding up delivery, right? Because that matters. Recognizing revenue matters. We're on an accrual basis. So cash could be received early from our customers. So think about when you book a hotel or you book a flight, you're paying in advance, right? Before the flight or before the hotel visit. Revenue could be recognized, or sorry, cash could be collected when you're recognizing revenue. So if I go to Target and I pay cash for the goods that I'm purchasing, revenue could be recognized before we receive cash. This is accrual basis. Why does cash matter? Why do we care about speeding up cash collections from our customers?
Most liquid.
Yeah, cash is liquid. I have to have cash to pay my customers. I have to have cash to pay my employees. I have to have cash to pay my vendors. I have to have cash to pay my utilities. If I don't have adequate cash flow from customers, then I have to borrow money. I either need new equity investors, people to purchase my stock, or I need to take out a loan from the bank. So cash absolutely matters. So here are the strategies that different companies can use, or different strategies that companies can use to speed up cash collections. So we want to collect cash from our customers as soon as we can. The longer it takes us to collect cash from our customers, the more likely that our customers are not going to pay us, even though it's owed. So remember that accounts receivable is an informal agreement between the buyer and the seller. We're giving you goods in advance and you're going to pay us in the future. Or we're expecting you to pay us in the future based on our terms. Most companies, it's their operating cycle. So 30 days, 60 days is pretty normal. Companies like Lockheed Martin, those that are building larger things, their industry is a little bit different. So their terms could be longer than that. But typically it is 30, 60, 90, 120 days terms. One of the ways that we can speed up cash collections is offering sales discounts. If you pay us within 10 days or 15 days from receipt of the goods, then you can take a small discount on how much you pay us back. So 2%, 3% discount.
So would that be kind of why like gas is cheaper when you pay in cash than card?
No, the reason why gas is cheaper when you pay in cash is because the credit card processing cost. It costs 2 to 5% every time they charge card. So it's costly, especially for smaller businesses. It's a huge, it eats into their profit.
Do they tax on that?
Do they tax on what? The 50 cents they're collecting?
Yeah, like you know how it takes only like $70 to make earrings, but then you sell it for like double that. You know, does the processing fee, is it cheap, and then they just raise
Okay.
it?
So the 50 cents that they're collecting from each customer that uses a credit card is going to be part of the revenue that they're recognizing. And the processing costs that Visa or MasterCard card is charging them is going to be an operating expense. So it would net out. Some
Okay.
companies, so if you're paying by credit card for like your property taxes, they actually charge you what the fee is, so it nets out to zero. But usually the 50-cent charge is basically they're charging you if it's a small dollar value that you're charging onto your credit card at like the small like mom and pop liquor store places, you know what I
Yeah.
mean? It's
Yeah,
like
yeah.
transactions under $5 or $10, it's usually just to cover the fee
Oh, okay.
because their margins are usually a lot more narrow than other companies.
Then bigger companies.
Yeah. The second way is they could charge interest after a certain period of time. So after 30 days, we're going to start charging interest if you don't pay us. This is very, very rare. Most companies are not going to go and charge interest. If a customer can't pay you in the first month, then the likelihood that they're going to be able to pay you plus interest later is slim to none. There are some very shady businesses that are charging you interest on things, so always read the terms. Dirty Money is a great documentary to watch if you want to know about any of those weird industries that are charging you additional interest on things like that for borrowing. But typically for AR, business to business transactions, they're not going to charge interest on those, even if they say they are. For the third one, adopt more effective credit and collection procedures. So this is internal controls right here. So we're not going to allow customers that historically are not paying us on time or paying off the amount that they owe to us. We're not going to give them the on account. We're not going to say, hey, you can pay us later, right? We're going to look at your history and say, are they paying us on time? Are they paying us the full amount? If they're not, we're going to say we need cash on delivery. So if you've worked in the restaurant and bar industry, a lot of those transactions are on account because the bars and restaurants are paying on time based on the terms established between those liquor companies and those vendors. But if they aren't paying, what happens? You have to pay immediately in cash when you get the delivery instead of on account. So adopting more effective credit and collection procedures is making sure that you're not allowing people who have a poor credit history to borrow, right? It's protecting you from having this issue of collection later on. The last way that companies are doing this is emphasizing credit card or bank card sales. Why is this a big one? It's cutting into their profit because they're paying a fee to Visa, MasterCard, American Express. Why are we going to emphasize credit card sales or bank card sales, debit cards? When does Visa pay?
Is that extra fee?
There's an extra fee, so it does have a cost associated with it. But why are a lot of companies adopting this? It's allowing people to use credit without the risk of loss on them. Visa is always going to pay Target. MasterCard's always going to pay, and they pay quick. They pay within 1 to 5 days, typically. When you swipe your card, your credit card or debit card, typically the cash is being transferred either from your bank account within a few days. If it's a credit card, the credit card company is paying it within a few days. So we're speeding up cash collections from 30-day terms to 1 to 2. The faster you can collect cash, the better. So previously, we used to actually record credit card transactions as AR from Visa, MasterCard, but now how quickly we're transferring money from these companies, it's actually just the equivalent of receiving cash. Does that make sense?
Yes.
Okay. So first one, we're going to look at actually these two. And there is one last one that isn't noted on this. So it's one that most companies are not going to go to unless they are desperate for cash. And that's factoring or selling receivables to a collection agency. Typically, they're going to receive about 60% of the value of those receivables. So they're taking a huge hit. They're only collecting about 60% when they factor them, but they don't have to go after their customers to collect. The problem with factoring is you basically ruin the actual relationship with your customer when you do so. When you sell those receivables to a collection agency, what is the collection agency going to try to do? Collect.
Yeah, place them down.
Yeah. And they're aggressive and they're annoying, and technically you don't even have to pay them once it goes to collection.
Yeah, it goes off your record in 7 years.
Yeah. So they can hit your record, they can hit your credit score, but technically you didn't have an agreement with the collection agency. So technically you don't have to pay them.
That's why
But they will.
don't pay anything on collections. It keeps going down and down because collection agencies keep selling to other collection agencies for a fraction of the cost.
Yeah,
Just
because they're trying to
some of the money.
recover any of the amount that they paid. So it's not a good situation to be in, but
Are you gonna take a credit hit though?
what was that?
When you don't pay them, like, are you gonna get hit with like a credit like deduction or something? Like, if people just don't pay the collections, like, what's the bad part of
So
that,
like
you
it
know?
hits your
They're
credit
gonna-
score pretty bad, but
Yeah.
so the statute of limitations on like collection agencies for the most is like 7 years typically. So like after X amount of time, it just falls off.
Yeah, it does.
Oh, okay.
7 years is a long time. Also, if you did have a collection agency come after you for something, it could be a charge that they actually don't have against you. So you always want to check. If you're receiving something from a collection agency, always check to make sure it was actually owed from you in the first place.
Okay.
And if
Thank
it wasn't owed from you in the first place, go back to the company that initially had that charge against you, not the collection agency, but the original company, because they need to deal on your behalf with the collection agency so it clears out. Just a heads up. I've had it happen.
Oh.
I will never bank with a certain bank again because of it.
Oh, dang.
Which bank was it? Just so we don't make this.
It was a very large bank and they already have issues that people know about.
Wells Fargo.
No comment. So they were charging my account that I had closed after I closed the account. They were
Okay.
charging fees, and I had closed the account. And then they sent those fees to collection even after I had closed the account. I'm like, I closed the account. Like, you clearly charged the fees after I closed the account.
How to play you.
It took months to clear, by the way.
Oh, wow.
So wanted that to share that with you. Speeding up collections. So we're going to look at a credit card, debit card example. So suppose Target Inc. skip this part, sorry. Suppose Target Inc. sells a television for $1,000 at one of its stores and the customer pays with a Visa card. Visa's fee is 2%. Target Inc. records the sale. So we're going to ignore the cost of goods sold right now. We're not going to record the cost of goods sold. The $1,000 is the selling price, right? We're going to multiply that $1,000 selling price times the credit card processing fee of 2%. So 0.02. And we're going to call this credit card discount expense. So for that $1,000 charge that Target made, how much of that $1,000 is Visa going to take? Anyone? You still there?
Still here.
Just checking. How much is
20.
20 bucks?
20.
Thank you. So that 20 bucks, the credit card discount expense is an operating expense for Target. The cost of running that business. That's one transaction. Every transaction that is using a credit card or a bank card, except for those signature cards. The signature cards that probably have a reduced fee on, by the way. But every transaction for Visa, they're charging 2%. So Visa is getting that amount. Why do a lot of companies not accept American Express?
Does it have a higher fee?
Yeah, American Express typically, I think, is on the higher side. It's one of the higher ones. So there's a range. It's 2 to 5%, and American Express is probably at the 5% level. It's a lot. How do I record this? What am I going to debit? What am I going to credit? So you're going to have 2 debits and 1 credit.
Debit cash?
Yes, so we're not going to get to the value yet. We're going to debit cash, increasing cash. We're going to credit what? We'll get to the second debit in a second.
All right, to go back, so the $20 is the credit card discount expense and the operating expense?
So it's an operating expense account. So this is the account name. Credit card discount expense is the account name. That account is an operating expense. I'll change the arrow so you can see.
Okay.
There you go. That better?
So would it be a credit to operating expense then?
No, so we're going to credit. We're recognizing revenue right here. Debit, cash, credit, what?
Sales revenue?
Yeah, sales revenue. We're still recognizing revenue. So we're going to credit sales revenue. Increasing sales revenue. How much do we record for the sale? How much in sales did we earn for this transaction?
980.
No. I'm glad you said that.
1,000.
$1,000. Yeah. The agreed upon selling price, right?
Um,
That's the transaction price. For the second debit, so we debit cash, increasing cash, we're going to debit the credit card discount expense. It's an expense account. Increasing the expense account for how much?
20.
$20. For the amount of cash that Visa is going to transfer over, you're going to see the netted amount. They don't transfer over 1,000 and then expect you to pay them back 20. Visa just takes it automatically. So we're going to take 1,000 minus the 20, and we're going to collect 980. Do you see how that works? So the 980 plus the 20 equals 1,000. So the debits equal the credits there.
Yeah.
When I'm talking about just the net income or the profit from this transaction, we're looking at sales revenue of 1,000 minus the discount expense of 20. So the profit from this is 980. Does that make sense?
Yeah.
Okay. Do you guys need a break? Do you want to laugh? Do you want to jump up and down? Smile?
use a break, yeah.
Okay. Take
Yeah.
a few minutes. Take a few minutes. Clear your head. Ask some
Yeah.
questions if you have them. Process it. Dory, I'm really jealous of like your location right now.
It's nice. I guess I don't know. It's right outside my backyard.
Well, if my daughter wasn't gonna come out, like I'm so afraid if I go outside that my daughter will just like sit in my lap or make a lot of noise or distract me too much. If
I turned off the video during the class because my dog kept running out and deciding she wanted to come hang out.
sounds about right. I told my husband, I'm like, our dog Romeo is like living his best life right now. All of his humans are home all day. He gets all these walks. His normal dog food was completely bought out by crazy people at Costco. So I had to get him the equivalent of McDonald's to him because it's like special. I took whatever I could get.
Okay.
So he's loving life right now. It's not McDonald's food, okay? It's like still it's like good food, but it's not his normal food.
Yeah. I actually came out here because we usually have like a little like coffee table nook area out here
Yeah.
that like is shared by all the neighbors.
Oh,
Because
nice.
this is just because it's technically nobody's actual area. It's just a canyon behind all of our houses.
That's so cool.
But I think the neighbor took it to their house. So I was like, okay, well, I guess I'm just gonna sit on the tree trunks that are making the path. It's a nice little hiking trail too.
They don't want shared space right now, shared germs.
Yeah, I guess it's fair, but
Always smart.
there's still like a lot of. I mean, I know I've seen several of the neighbors walking past. So
That's perfect. I just saw my neighbors walk past.
it's a better view than my kitchen table.
Oh yeah. Being outside is good for you.
Yeah.
There goes my dog. Anybody have any questions?
So with this chapter, we're going to pretty regularly have more debits and credits.
Yeah, pretty much.
Okay.
Yeah, because contra accounts are going to be debited too. Yeah.
And so when we're recording a discount expense, do we just record it as discount expense or credit card discount expense or?
Yeah, either of those.
Okay.
Technically, it's credit card discount expense. That's what the system's going to make you do, but discount expense is fine too.
Okay.
Yeah. And I have seen companies use miscellaneous expense for those ones too. But for the system, it's going to want you to do one specific account. You guys ready to get going? Servette is.
Yeah.
Okay. So the credit card processing, when we do that, it is a expense account, but the next things that we're going to look at, sales returns and allowances, and then sales discounts, those are actually going to be contra revenue accounts. So a little bit different. So we're going to look at sales returns and allowances. I forget, has anybody taken financial accounting before, like number of years ago? If you have, stuff changed specifically for this, so it's going to be different than what you're used to. So the old way is out. For sales returns and allowances, this is basically the right for a customer to return things, right? And they receive a refund, or sometimes they receive merchandise credit. It depends on the terms. So it's the right to return unsatisfactory or damaged goods. The way that accounting treats it is we're actually going to consider the sales returns and allowances account to be a contra revenue account. So when I make a sale, the full amount, that $1,000 for that TV, that's the gross sales revenue. But if I am allowing some of my customers to return some of their goods that they're choosing, then those items that are returned or expected to be returned should actually be reducing the amount of net sales that I'm recognizing. So we're going to reduce the value of the sales revenue that we're recording in our income statement by this contra revenue account, sales returns and allowances. If you look at the financial statements of any company that sells goods, you don't see gross sales revenue anywhere. What we're reporting to our investors and our creditors is net sales. Companies are going to keep track of their sales returns. They're going to keep track of those damaged items that they had to give an allowance for or a discount to their customers for, because that's good for operational procedures. But for external financial reporting purposes, the investors and creditors don't know about this information. When we do have a return come in and a customer has paid us on account, we're going to issue a credit memo. So it's basically a record of that return, because we're going to be reducing accounts receivable with a credit, right? And usually the only time that we're crediting accounts receivable is when what happens? When do we credit accounts receivable?
When the customer like pays us back.
Correct. So typically you debit accounts receivable when you make a sale on account. When the customer pays us back, we reduce accounts receivable with a credit. So when we provide a return of goods, well, we need to reduce their account with a credit. We want to have a separate authorization of it, because a way for an individual to steal cash from the customer, from the company, is to take the cash that's collected and then reduce the AR. It's okay. So we want to have a separate record for internal control purposes. We're going to look at an example. The way that we deal with sales returns and allowances is different because basically, if we're saying that we allow you to return goods for up to 60 days, we know that some of those sales, people are going to return a majority of what they purchased. If we know historically that customers are returning 20% of the goods that we're selling, but when they return it, it's usually in a different period than when we sell it, because if we're allowing them to return goods up to 2 months later, we're recognizing revenue now, but we're not going to recognize the return until later. That doesn't make sense. So under the new revenue recognition rules, we actually need to estimate how much we're expecting in returns from our customers. And we're actually going to take the hit to our sales revenue at that point in time when the sale happens. So we're going to record a reserve for future estimated returns at the time of the sale. So we're going to look at an example. Suppose
Wait.
Madeline's sorry, what was that?
No. So I was just gonna say, wouldn't that be hard to like calculate your revenue if you're keeping in mind that it might be returned? All the items
So
that you're
if we were hitting it directly to the revenue account, then yes, it would.
So question, like for example, like I work in retail and
Yeah.
we already take account stuff that might be stolen into the like the final whatever they record, I don't know. But they
Yeah.
already kind of take account how many things will probably be stolen throughout that period.
Yes. So you're not recognizing revenue on what's stolen, first of all. So it's not going to impact this side of it, but it's going to impact the cost of goods sold side. Oh, hi, baby. That door should be closed. For those expected theft parts, it's probably an estimate so that they can reduce cost or reduce inventory and increase cost of goods sold.
Okay.
Yes, I am. Wait 1 second. Bye, baby. Sorry, guys.
So cute.
Okay. For Isabella, your question, what we're doing is we're doing a look back. It's a historical percentage. So a new business, we don't really have an estimate of how much customers are going to return, but for companies that have been in operations for a while, we can easily estimate how much we're going to return historically, how much has been returned.
Oh, okay, yeah, that's right. Okay.
Because we're keeping track of it.
Right.
So suppose Madeline's department store allows customers to return merchandise within 60 days for a full refund. Historically, 5% of Madeline's sales were returned. During the month of September, the store's total sales were $5 million. So we're going to record the estimated sales returns and adjustment to inventory, but we're also going to record the sale and then cost of sales. So first things first. So since we're going to recognize it as of September 30th because we're looking at the whole month, we're going to record the sale just like normal. We're going to assume that the sale, sorry, I need to look at my notes to verify that. We're going to assume the sale was for cash. So on September 30th, we're going to debit cash, increasing cash for $5 million. That's how much we collected from our customers. And on September 30th, we're going to recognize revenue. So credit sales revenue, increasing our revenue account by $5 million. So we're still recognizing in the revenue account gross revenue. So gross sales value. The full amount. So if you think about in terms of your work, gross is the number of hours that you work times the rate that they're paying you. Net is how much your paycheck is for after those taxes. We're going to record the cost of the sale on the same date, right? So September 30th. And it says assume cost of goods sold is 60% of sales. So we're going to have to do a little calculation. So sales is 5 million times cost percentage of 60%, so 0.60. Cost of goods sold was how much?
3 million.
3 million, yeah. Okay, so we're gonna debit what? Cost of goods sold. So debit cost of goods sold. Increasing cost of goods sold by 3 million. And we're gonna credit inventory. Reducing inventory for 3 million. Same two journal entries. So recording the sale is normal. Recording cost of sale, normal. The not so normal part. Now we need to record our estimated sales returns. So if we're saying historically 5% of our sales are returned to us, we need to reduce net sales by those 5%. So what we recognize as net sales is actually 95% of the revenue, right? So we're going to take sales revenue, gross sales revenue, times our estimated percentage of returns. Do you want me to make that bigger? Or is that good? So our gross sales revenue was the 5 million times an estimated 5% of those sales are returned. So of that 5 million, how much do we expect to come back? As a return?
250,000.
Yeah, $250,000. So on the same date, in the same period that we recognize sales revenue, we're going to reduce for those expected returns. And at the same time, we're going to reserve for how much cash we're expecting to pay back. Okay, so we're going to establish a liability account. And if a customer paid on account, then you would establish an allowance for those expected returns. So we're going to debit sales returns and, we're debiting sales returns and allowances. increasing that account by 250,000. And we're going to credit a new account, sales refunds payable. Increasing the payable for 250,000. So sales returns and allowance is a contra revenue account. It has a normal balance of a debit. You're pretty much always going to be debiting this account. The only time you would be crediting sales returns and allowances is if you're adjusting it. If their estimate was more like 8% and it would materially misstate their financial statements, you might have to adjust the initial sales returns and allowances. For sales refunds payable, this is a liability account. So it's going to have a normal credit balance. When I reserve for those expected refunds, it increases the account. When actual refunds come in, it's going to reduce that account. Notice here that I'm actually reducing the amount of profit that I have right here. When I debit that sales returns and allowances in the same period that I recognize that sale, it's actually reducing the amount of net sales revenue that the company is actually reporting. Since you're reducing the amount of revenue you're recognizing, it wouldn't be right to not reduce the expense related to it. So you're also going to record on September 30th the expected inventory returns. So there's a couple different ways that you can calculate it. The 60% is going to be used the way that I'm going to do it. So you can take 250,000 in expected returns times the 60% to get the amount. Or you can take cost of goods sold times the 5%. You're going to come out to the same number. So I'll do the cost of goods sold one first. So cost of goods sold for the period was 3 million times the expected percentage returned of 5% is going to equal the estimated returned inventory of 150,000.
I have a question.
Yeah.
What's the difference between the sales returns and the inventory returns? Because don't they have like a direct correlation?
So the sales returns and allowances is actually going to reduce the amount of revenue that you're recognizing. The expected inventory returns is actually going to increase the assets in a way, and it's going to reduce the cost that you're recording. So it's netting out. One's going to be reducing the revenue, the other one's decreasing the cost. So it's netting out to a lower amount
Okay.
of impact. If you only recorded the sales part, then it would be a bigger hit to your profit. When you're recording this part, it's reducing the cost, so it's a smaller hit to your profit.
Okay, cool. Thank you.
Yeah. So on September 30th, we're going to establish a new account. You're not going to record it back into inventory because you don't actually have these goods yet. So you're essentially saying establishing a new asset account of fake inventory or inventory you don't really have, but you're expecting to have in the future again. So we're going to debit inventory returns estimated. Increasing the asset account by 150,000.
Will that be considered an asset?
Yes, it is. Yes, it's an asset. Because they will have it in the future to sell in the future. And then we're going to credit cost of goods sold. So remember how I told you in earlier chapter, there are very rare occasions that you're going to be crediting cost of goods sold. This is one of them. Under the old rules, we basically ignored returns until they came in. We didn't establish that we're going to expect inventory coming back. We didn't establish that some of those sales are actually going to be returned in the future and are historically returned. But now under the new rules, we have to. It makes more sense. It does give a better reflection of the company on that period of time. And it's hitting and impacting the income statement in the period of the sale. So what I want to do really fast is kind of just show you the income statement side of this transaction before we get into the actual return. So you start with gross sales revenue, 5 million. And then you subtract out your contra accounts. So if they had any sales discounts, it would be subtracted here too. So you have sales returns and allowances. So remember, sales revenue is that credit account. Sales returns and allowances has the debit, so it's the netting effect. 250,000 is being subtracted. So net sales revenue, and this would be what you're reporting in the income statement first. Is 4,750,000. Then you're going to subtract out cost of goods sold. So cost of goods sold increased by 3 million, right? With that second transaction we recorded. And then decreased by 150,000 with that fourth transaction. So 2 million, is it 850? and then gross profit. So basically, how much could we charge above and beyond our cost basis? 1.9?
Yeah.
Okay. So that's what we would show that in the income statement. Without that rule, we would have actually been showing 2 million gross profit. So the point of this is that when we take the hit to the income statement is when we record the sale. When customers actually come back and return goods, it doesn't impact the income statement at all. So what I'm going to do is set up 2 T accounts for you because we're going to pay attention to them. Sales, refunds payable. The liability account, so the beginning balance is over here. So we added 250 to this account on 9/30. And then inventory returns estimated. And we added 150,000 on 9/30. Do you think the likelihood that exactly $250,000 worth of returns is going to happen?
No.
No, it's going to be either higher or lower, but it's an estimate. We're okay with it. We disclose in the financial statements, we use estimates. Every year we're testing and seeing and doing a look back to see if those estimates are realistic or not, and we're adjusting if they're not, if they're materially different. So when an actual return comes in is what we're going to look at now. In October, within the allowable return period, customers returned merchandise of $200,000 that cost $120,000. So we need to record the actual sales return as well as the inventory that was returned. So basically, the only thing that's going to happen here is that the balance sheet is just going to shift between accounts. So October 31st is when we're going to record this. And we had actual returns. So this is the sales value of the returned items. Was $200,000. So on October 31st, we're going to reduce that liability, the sales refunds payable. So we're going to debit sales refunds payable. For the actual returns, 200,000. And we're going to credit cash, reducing cash for the amount we pay out. So we're reducing a liability and reducing an asset. No impact on the income statement when an actual return comes in. So the balance after this transaction in that sales refunds payable is 50,000. That 50,000 is reserve for expected future returns. That we're going to probably refund. On the other side, if they return inventory, it's no longer going to sit in that fake inventory account. Now it needs to be moved to the actual inventory account. So we're going to, on October 31st, we're going to debit inventory, increasing inventory by 100 and, or sorry, not 150, by 120,000. The cost basis of the actual inventory returned. And we're going to credit which account? Inventory returns
Then
estimated. Yep. Reducing the asset account. So we're just shifting it from one asset account to another asset account. Over here, it was just shifting from a liability and out of the asset, right? So basically what happens when actual returns come in is just a balance sheet shift around. That's all it is. It doesn't ever impact the income statement. The income statement impact happens when we record the revenue. So we're going to credit the inventory returns estimated for 120 on October 31st. And now 30,000 is our balance, right? In that inventory's returns estimated. Expected future returned inventory is what the balance stands for.
I have a question.
Yeah.
Where is that remaining 80,000 representing of the difference of the two numbers?
The 80,000, where's the 80?
Or the difference between the 200,000 and the 120,000, like how can you help explain?
Oh, how did I get to that? Okay. So it's the profit.
Oh,
So
okay.
the 200,000 was the sales. If you took 200,000 times 60%, which was the gross profit, or sorry, the cost of goods percentage up above.
Just trying to keep.
There's your cost basis.
Okay.
Yeah. Because that's essentially your cost of goods sold percentage.
You're right. I forgot about that. Okay, cool.
No worries.
Thank you.
Yeah.
There we go. Yeah.
There you go. Okay, other questions? Do you guys have any questions from the chapter 4 homework? Did you start it?
Do not have any questions yet on that, but
Okay. Send them around or send them to me if you have any. Do you have any questions on the chapter 5 pre-assignment?
No.
No? Anyone?
I mean, it's a little bit easier to understand now, so
Yeah.
No, you can totally go back and do it and correct it. I know this part of the chapter especially is more complicated. Under the old rules, I could have blown through this section a lot faster. It wouldn't have taken me a full whole period for that. But I know it's much more complicated, and that's why I go a little bit slower through it. I don't usually test you on this part. You'll just have it in your homework.
Okay.
Okay. but especially if you're going to move on to as an accounting major, you guys need to know this information. It'll make it much easier when you get into intermediate accounting. But if any of the percentages or anything like that isn't making sense, let me know. But definitely practice the pre-assignment again before you jump into the homework. You have spring break next week. A week off in accounting, is a long time.
Mm-hmm.
And you already had a week off last week. So if you can, try to do some of the homework, try to do some of the practice problems just so you don't forget it. I know it's spring break. You don't have to. It's not required, but I'll be checking my email, but not as regularly over spring break. Obviously, if you had plans to go anywhere, you're probably not going. So sorry. Probably the worst spring break ever. Hopefully we get some sun next week.
It's even worse now that we can't go to the beach or anything.
Yeah,
That's true.
I know.
There's actually like cops driving down the border.
Oh, wow.
Well, because they said that if anybody is gathered together, even if it's like your family, they're gonna fine you $1,000.
That's a $1,000 fine.
Yeah.
Yeah, it's a misdemeanor.
I'm just going to stay at
Yeah,
home.
misdemeanor too. It's more than just an infraction. What'd you say?
Who said that?
I'm just going to stay at home just to play my Age of Empires. Who needs
Well,
to
then
go outside
play
when
some-
you're being
Practice
quarantined?
some accounting too.
Yeah,
you guys-
that's part of my plan too. It's
Perfect.
like a
That's what I like to hear, Joshua. That is what I like to hear. If you guys do the dynamic modules, I'll give you extra credit.
Okay.
So I think it's really useful. Yeah, it's in my accounting lab, and it's the dynamic. It's dynamic something. I'm blanking on the word that it's called. But one of my online classes they've been using it a lot. A lot of the students were using it before the first exam, and they really found it helpful. And just kind of solidifying your understanding of the basics. And if you understand the basics, then these later chapters are more easy for you. So I'll give you extra credit if you do it.
Okay.
I have a quick question. So, are we going to be continuing chapter 5 next
Yes.
after our spring break?
Yeah.
Perfect.
I can get through chapter 6 pretty quick. It won't take me as long as chapter 5, so I might spend 3 days on chapter 5 so that you get all the information. Chapter 5 is a bigger chapter for sure. Any other questions, you guys? I have 2 minutes, but
Will you post this lecture on Canvas again?
yes. Sorry it took so long last time. It was a battle trying to get it. I had to, I thought I could just post it, attach it, but it was too big of a file. It wouldn't attach. I had to upload it to YouTube. YouTube denied it the first time because it was over 15 minutes long. So then I had to get an override for it. Finally worked. It didn't take as long. It's not captioned because it's going to take me a very long time to caption it at this point. So if you want it captioned, let me know, please. But yeah, it is uploaded, and I'll upload it tonight for you. Does that help, Enzo?
Perfect.
Muy bueno.
Have a good spring break. Let me know if you need anything. Thinking of you guys.
Thank you.
You too.
Okay. See ya.
All right.
Bye, guys.
Bye.
Any other questions before I hang up? Bye, guys.
No, thank you.
You're welcome. See you later.
Oh, are you posting
I'll post it.
on Canvas the live
Yes.
recordings?
Yes, I will. Later. It'll be like later tonight.
Okay. All right. Cool. Thank you.
Bye. No problem.
Bye.
Professor,
Uh-oh. Yeah?
I'm taking your class online. So
Hi.
am I going to be able to? Hello.
Oh, yeah, I'm gonna post it. I didn't post the initial one, the initial video, because it took me forever to figure it out, but I'll post both of them today.
Oh, okay.
Yeah, I'm glad you could join us.
Well, I came in pretty late. I didn't know, but I will try.
No, and it'll be the same time Monday and Wednesday. So after spring break, if you just want to put it down, if you're home and have time, you're welcome to come.
Yeah, I'm home all day long.
I figured. That's why it's like the one time that my online students can actually come.
I know.
So
Okay, well, thank you very much, and I'll
No
help
problem.
you later on.
sounds good. See you later.
Okay, bye.
Bye. Does anybody else have any questions? Bye, guys. I'm going to shut you down.